because I know some people are registering, but the next ones I will not record. People have to show up.
Okay.
Okay. So let us start.
Yes.
So this topic will be on life assurance and life annuities, just to describe the nature of the products, so that by the end of the lecture, I should be able to describe the traditional life assurance products and describe the modern ones, also describe the life annuity and distinguish between life assurance products and life annuity products. So similar to our previous topics, I have begun with the case applications of two things, that is the life assurance and the life annuities. And this is simply to help us appreciate the context of what we are learning and how it can be applied in real life. So for this, for the case application, I will read it word for word. So I have that Brian, who is aged 20 and is a structural engineering student at a local university. His father died recently from prostate cancer, and he had no life insurance. At this point, let me note that the term life insurance and life assurance mean the same thing. It's only that the terminology life assurance is often used in the UK, and the US use life insurance. So you can use them interchangeably. They mean the same thing. So when we speak of, so we continue the story. So since Brian's father was a disabled veteran, the Kenya Defence Force provided a modest amount of financial help. The actual funeral costs, however, were almost double the amount provided. As a result, Brian's mother was burdened with severe emotional grief, substantial debt, and the uncertain future. She experienced considerable financial pain trying to determine how she would pay for the funeral. Brian's mother was uncertain she would continue to provide financial help to Brian and his sister, who was also in university. His mother admitted that she probably will not be able to keep up the house, and Brian's pursuit of an engineering career was in deep jeopardy. So in the above tragic case, the death of Brian's father caused great economic insecurity to the family. So this is an illustration of a gap that could have been filled had Brian's father bought a life assurance or a life insurance policy. So we shall see how the different types of products will have come through for Brian's family in the event of the death of their dad. So the next example is a case application where a life annuity can be applied in real life. So we have Justin, aged 26, recently accepted a job as a sales representative for a life insurance company in Mombasa. She has several financial goals, including paying off her health loan and saving for a comfortable retirement. The head of Human Resource Department explained to Justin that she will not be eligible to participate in the company's retirement plan for 1 year. She explained further that Justin should consider establishing an M-Pension individual retirement account with a CPF individual pension scheme, which is registered under the Retirement Benefits Authority during the interim period. So that means that she will be procuring her own private pension scheme. She could start saving money immediately for retirement, and the investment income will accumulate income tax-free, and the retirement distribution would also be income tax-free. So just like Justin, millions of workers dream of achieving financial independence and a comfortable retirement. Planning for a comfortable retirement should receive high priority in a personal risk management program, especially since longevity has increased and people are living longer, and the retirement period increases with longevity. Yet the current research shows that a majority of workers are not financially prepared for retirement, and the amounts that workers have saved for retirement are relatively small. So how a life annuity comes in with respect to pension monies is that once a worker retires at their retirement age and they receive a lump sum from their pension scheme, then they can purchase different types of annuity to help them be able to earn monies over the period of time. So we shall see again how the life annuity comes in with respect or in the context of this particular um, case application. So we shall narrow down to life insurance and life annuities. And before we look at the specific types of contracts, let us see how the life insurance contracts and annuity contracts have evolved over time. So historically, and life insurance and annuity was the major application of actuarial techniques. And we have said that in our objectives or in our learning outcomes, we have both traditional and modern types of contracts, so that the modern contracts have evolved from the traditional ones, and the evolution has been informed by several reasons. And the first reason is that there has been increased interest in insurers, that is the life insurance companies, in offering the element of both savings and insurance. So a key distinction between the traditional ones and the modern ones is that the traditional ones only offered the element of insurance. However, they did not give the policyholder or the insured party the element or the chance to actually make a savings out of the product. So that's why there has been that evolution from traditional to modern. Another reason is that now there are more powerful computational tools that allow for complex products to be modeled, so that now you'll have the modern products incorporating both the insurance element as well as the savings element. Another reason why there has been that transformation, so policyholders have become more sophisticated investors and require more options in their contracts, so that they will so that it is not policyholders do not want terms that are fixed, but they want to be able to have contracts which allow them to vary the premiums of the sum assured that is being offered. So this again comes because of competition, so that if all companies were offering traditional products, then it means they will be competing for clients or for potential policyholders using the same types of products. And that does not give either of the companies an edge. So all this is in response to what the masses need, what do customers need. And that is how it is achieved through the evolution. So another part is the risk management technique, another reason. So in the risk management techniques in financial products have also become increasingly complex, and insurers have offered some benefits, particularly financial guarantees that require sophisticated tools of financial engineering to measure the risk and manage it. So that is also another reason why we have evolved from the traditional ones to the modern ones. So we shall now look at the traditional types of insurance contracts, and these form the basis of even the modern types of contracts. So even when we speak of the modern, it will be a modification of either of these types of contracts, which will now incorporate the element of saving. So the first type of contract is what we call a term insurance or a term assurance. And this type of contract pays a lump sum benefit upon the death of the policyholder. So that means it is not the policyholder that will be paid this amount because already they will be dead. it is now the beneficiaries of the policyholder who will receive this lump sum benefit. So, and this benefit is only paid to the beneficiaries of the policyholder, provided that death occurs before the end of a specified term. So that means that if we speak of a 5-year term assurance policy issued, let's say, to Brian's father, if they died, let's say, on the 3rd year of that contract, then Brian and his mother are entitled to the lump sum benefits. However, if Brian's father survived to the end of the term, meaning that they continue to survive or they are alive even at the end of the 5 years, then no lump sum benefits will actually be paid either to him or the beneficiaries at all. So we are saying that in this type of contract, death has to occur within a specified term before the beneficiaries of the policyholder can become entitled to the policy, or to the lump sum benefit that is payable by the insurance company. So David, is that distinction clear of how the term assurance works? And will you purchase a term assurance contract?
Yeah, the term insurance is clear, madam.
Okay. Sawa sawa. So given that those are the characteristics of the term assurance, we have now modifications which now define subgroups of the term assurance. So the first one is what we call the level term assurance or level term insurance. And this indicates that a level sum insured and regular premiums, which are also level. So when we speak again of a life insurance contract, we want to look at it this way. It means that the policyholder will continue to be paying premiums. And in this case of level term, we are saying the premiums themselves, the amount of payment of premium are level, meaning they are constant. So they will pay constant level amount of premiums throughout the period or throughout their life. And also the sum assured, which is payable to the beneficiaries upon the death of the policyholder, is also constant, or it is also level. So when both the premiums are constant and the sum assured payable is also constant, then we speak of a level term assurance or a level term insurance. Conversely, we can have a decreasing term insurance, and this indicates that the sum insured, and usually the premiums as well, decrease over the term of the contract. So this is a case, again, you're not having the constant sum assured or the constant premiums being paid regularly, but rather over the years, as we approach the maturity of the contract, then sum assured payable to the beneficiaries is decreasing, and the premiums being paid by the policyholder is also decreasing. And this is most popular in the UK, where there is the term assurance is offered in conjunction with a home mortgage or a home loan, so that if the policyholder dies, the remaining mortgage is actually paid by the term insurance proceeds. So we also have the renewable term insurance, and this offers the policyholder the option to renew the policy at the end of the original term without further evidence of the policyholder's health status. So remember, we have said that under this type of contract, if the policyholder survives to the end of the term, the beneficiaries or himself or herself will not actually be paid any monies. So it means, therefore, that if you have a renewable term insurance, if Brian's father, for instance, had a renewable term insurance policy, and the term was 5 years, so it means if they had survived to the end of the term, that is the 5 years, they will have just renewed that contract for another 5 years. Yeah. Then the last one, the last modification of the term is what we call a convertible term. And this now offers the policyholder, that is Brian's father, the option to convert from a term assurance into another type of life insurance contract. So it can either be a whole life insurance or an endowment insurance contract that is at the end of the original term. So at the end of the 5 years, again, Brian's father would have considered to probably convert their policy into a whole life or into an endowment insurance contract without further evidence of the medical status. So any questions on the term, David? Questions on the term?
Yes.
Okay, yes.
Can you pardon on the increasing what the
The
increasing
decreasing term.
yeah.
You've understood the level term, right?
Yes.
So with the decreasing, this is a scenario. Okay, let's go back to the level one. So with the level, we have said both sum assured and premiums are constant. So if we assume that Brian's father had purchased a level term insurance policy with a sum assured of 500,000 and level premiums of 10,000, it means that Brian's father will continue to pay these regular premiums of 10,000. Let's assume that's annually. So they'll continue to pay that amount until they die, right? So if they die within their first year, because it is a level term assurance, then Brian's mother and Brian, if you assume that they are the beneficiaries, will be entitled to the sum assured, the constant sum assured of 500,000. Assuming Brian's father died in the second year, they will still continue to pay up their premiums of 10,000. And the sum insured or the sum assured payable to the beneficiaries, that is Brian and his mother, will still again be 500,000. So it will be constant from year on until the point in time at which Brian's father survives the end of the term. So if Brian's father survives to the end of the term, then no benefit, no sum assured is actually payable. So that once we come to the decreasing term, in this case, it means that now the sum assured and the premiums will be decreasing over the years. So the sum assured, let's say in year one, will be 500. The sum assured in year two will be 450. In year three, it will be 400, 350, and so on. In the same manner, the premiums again will be decreasing. So that in the first year, Brian's father should pay a premium of 10,000. In the next year, maybe 9,000, 8,000, 7,000, and so on. So that is the distinction. So that in the first year, if Brian's father died within the first year of the 5-year term, decreasing term assurance contract, then Brian and his mother will be entitled to a payment of 500,000. If he died in the second year, then the sum assured payable to Brian and his mother, who are the beneficiaries, will only be 450 and not the 500,000. So that is now what we mean by the decreasing of the sum assured. And in the same manner, the premiums will also be decreasing, so that in the first year, Brian's dad will be paying 10,000 in terms of premiums. In the next year, it will be an amount which is less, let's say 9,000, like so, until the end of the term of the contract or earlier death. So is that distinction clear?
Yes.
Okay. So So that is the first contract, term assurance. And we have seen that it is possible to have the level, the decreasing, to also renew it with the same terms, also convert it. And one of the conversions we have said is you can convert it into a whole life. So how our whole life works is that it pays a lump sum benefit to on death of the policyholder. Again, remember, because the contracts we have so far covered are payable upon death, it means that the monies go to the beneficiaries of the policyholder. So this contract pays a lump sum benefit on death of the policyholder whenever it occurs. So the difference here, or the key distinction here, is that it is not restricted that death of this policyholder must occur within a certain period of time. So if death occurred within the first year, they will be entitled to the sum assured. They will have been entitled if death occurred 10 years from the issue of the policy. So again, premiums here are paid on a regular basis, and often they are stopped when someone reaches age 80, so that it avoids the problem that older lives may be, because they're no longer working. When someone gets to 80, they probably retired 20 years before and may not again be able to afford to pay their premium. So even when they're being priced, often you'll find that there's that caption on the age limits, which will be considered. So in that case, that is the distinction. I hope it is clear on the distinction between the whole life and the term. Here we are not considering that death should be occurring within a specified period of time. So we have the next one, which is called the endowment. Now the endowment now offers the policyholder a maturity benefit, and there's also a death benefit. So usually, again, it offers a lump sum benefit to be payable either on death of the policyholder, so that in that event, the money go to the policyholder's beneficiaries, or at the end of a specified term. So whichever occurs first. So in this case, again, we are saying that an endowment needs to be issued for a certain period of time. So if we speak again of a 5-year endowment assurance policy, so if we assume that Brian's father bought a 5-year endowment assurance policy with a sum assured of 500,000, and they are paying regular premiums of 10,000, it means that if his death occurs between their first year and before the end of the 5th year, then Brian and his mother, as the beneficiaries, will be entitled to the lump sum benefit of 500,000. However, if Brian's father survives to the end of the term, the end of the 5 years, it means that the sum assured will now be payable to him. So you can see the contrast here between the endowment insurance and the term insurance. Here we now have a maturity benefit payable to the policyholder. So we consider this to be a mixture of a term assurance benefit that caters for the death benefit part and the savings element benefits. Someone, Munene Nyaga, kindly mute your microphone because we are recording this. So it has that a mixture of the death benefit and as well as the savings element. So this is often a more preferred type of policy, because you have the policy being issued for a specified period of time, and it offers both the maturity benefit or the death benefit. So we also have a modification to this, what we call the pure endowment assurance. And now with the pure endowment, it only offers the survival benefits. So with the pure endowment, it offers a lump sum benefit that is payable at the end of the specified term, so that we can now regard an endowment assurance to be both a combination of a term assurance and a pure endowment assurance type of contract. Now, you realize with all those contracts we have spoken of they are only covering situations where death occurs. So we have a modification of what we call the participating insurance, which now offers an element of proceeds to be shared, to be shared with the policyholder. So
Excuse me, madam.
Yes,
You have said
David.
that the pure endowment is only payable at the end of the term.
Yes.
What if the policyholder dies before the end of the term? Will the beneficiaries be compensated?
No. So with a pure endowment, it is a maturity benefit. It is not a death benefit. So the policyholder is the one who will be compensated if they survive to the end of the term. Is that okay? David, is that clear?
Yes.
Okay. So we can now look at participating. And participating are also known as with profit types of contracts. And we classify this again still as traditional because the main element of participating insurance is not necessarily the investment part, but still the larger part of the contract is tied to the insurance. And so therefore, we will consider it still as a traditional type of contract. So under participating, the profit earned from invested premiums. So a portion of the premiums collected is invested, and the proceeds or the profits earned from this investment of premium is shared to the policyholder. And this sharing can take several forms. So in America, you find that these profits are shared in terms of cash dividends. So that is one form in which they can actually share the profits. So it can be a participating endowment insurance contract, so that it has the element of the mortality. It is covering the risk of mortality or the risk of death, so that in the event of death, again, the beneficiaries of the policyholder will be compensated. But now it now has an element in which profits from invested premiums will be shared as well, so that cash dividends is payable to the policyholder. Or it can also be, the profits can also be shared in terms of reduction in premiums. So that if they declare dividends of, let's say, 1,000, then instead of them giving you that 1,000, then they reduce your premium by the 1,000. So that is what happens in America. Now, in the UK and Australia, the profits are shared in terms of either what we call the reversionary bonuses or the terminal bonuses. So when we speak of reversionary, it means that these are bonuses which are awarded within the term of the contract. So they will be probably paying bonuses every year. Yeah. And when we speak of terminal bonuses, these are now bonuses which are added at the end of the policy contracts. So again, if we speak of a 5-year participating endowment assurance contract and a reversionary bonus of 5% of the sum assured is declared per annum, then it means that this bonus will be paid or will be added to your sum assured every year at the 5%. And if it's a terminal bonus, again, it means that that 5% is only payable at the end of the contract, at the end of the 5 years. So we are saying that reversionary bonuses are actually expressed as a percentage of the total of the previous sum assured plus the bonus, or as a percentage of the original sum insured plus a different percentage of the previously declared bonuses, so that it will be growing from 1 year to the next. So the rate at which these bonuses are payable, that is the reversionary as well as the terminal bonuses, cannot be fixed at the very onset, but rather depends on the investment performance that the insurance company will actually be able to achieve with the invested premiums. So that we are saying these participating insurance contracts, they offer the policyholder that bit of the savings element along with their life assurance policy. So their primary focus still remains to be life insurance cover and not the savings element, which is now the key distinction from the modern types of contracts, which now for the modern ones incorporates a large element of the savings. Any questions? So we can look at the modern ones. So the modern ones are now, this is a scenario you have seen, for instance, in a term assurance, a level term assurance, it's possible for no one to receive any sum assured benefits in the event that the policyholder survives to the term. And we have seen that even with the participating, it is really dependent on how the company performs, so that in there are cases where if the investment performance is low, the company may choose not to declare any bonuses at all. So these modern types of contracts now come in to offer flexibility in the products, so that they combine both the death benefit coverage as well as the savings element or the investment elements. Yeah. So the investment element is really key in these modern types of contracts. So we have the first one. So the universal life insurance, and this again combines both the investment and the life assurance cover. And in this particular type of contract, the policyholder determines a premium that they can actually afford to pay for. So that if two people are aged the same and they are of the same gender, it is possible for one to say they can only afford to be paying 10,000 in terms of premiums, and another person to actually say they can only afford 5,000, so that the sum assured will be reflective of the premiums they are actually paying. So that is again a modification or a flexibility that is being offered to the policyholders away from the traditional types of contract, for which you would probably be indicated this is a contract offering 5 million sum assured and you're supposed to pay 50,000 in terms of premiums. Here, under the universal life, the policyholder can actually choose the amount of premiums they can afford, and the insurance company can determine how much in terms of the sum assured the policyholder is actually going to be paying for. So that's the flexibility offered under that. Now for the unitized with profit insurance contracts, this is now an evolution again of the participating of the conventional with profit types of policies. And in this, you realize we say that it is at the discretion of the insurance company to actually determine how much in terms of reversionary bonuses or terminal bonuses or the cash dividends that they're actually going to pay to the policyholders. And in some cases, they can actually choose not to pay in a particular year. Now, with the unitized, it means this brings in a more transparent element, in the sense that the premiums the policyholder pays for their contracts, part of it is actually used to buy what we call units. And these units can be perceived to be shares into an investment fund. And this fund is the now with profit fund. So Brian's father would have purchased a unitized let's say, a unitized endowment with profit insurance contract. So it means that a portion of the premium will go to meet the life insurance cover, and the other portion will actually be used to meet the investment part or the savings element part. So that bit used for the investments, so that premium is now then used to purchase units. They purchase units of an investment fund, which is now the with profit fund. And as the fund is invested, it will earn some investment return. And this will now increase the unit value or the share value of Brian's father into the fund, so that it is out of the increase of this share that the insurance company will pay the reversionary bonus. So you can see the transparency therein. It's at the very onset, you know how much will actually be attached into the investment fund or how many units are actually purchased. So that we are saying that the units in this case will not decrease in value. So you will always expect, you do not expect a situation where these shares or the units will actually perform low. So this is, I want to make it clear that these shares we are referring to are not the shares which are traded in the stock exchange market. No. Remember, in this case, so many people will be purchasing these same contracts. So they'll be purchasing, we'll be pooling our resources, and the monies or the proceeds obtained will be invested in a pool of funds. So it is not that it is buying a particular stock, but rather it's an investment pool, and the investment pool can be contain different types of assets or different type of financial assets. So on death or maturity, again, remember this is tied to a traditional type of contract. So either on death or maturity, a further terminal bonus may be payable depending again on the performance of the with profit. So that's the unitized with profit insurance contract. So we also have what we call the equity linked, and the equity linked can be looked at in two different forms. Again, we are saying that in this case, it's a situation where we want to cover both the life cover as well as the investment part or the savings part. So the first form is where the policyholders' premiums are invested in an open-ended investment company style, so that at maturity, the benefit is the accumulated value of the premiums. So you see the distinction here. Here we are saying that in this case, the benefit is tied to, or the sum assured payable is tied to the much the premiums have now accumulated in value. And because we have situations where, you know, the longer you invest your money with a company, the more it will grow. So that in the earlier parts of the contract, you do not expect the premiums to have accumulated into a huge value to warrant a sum assured. So you often enough, the equity linked contracts are offered with the minimum guaranteed death benefits, so that irrespective of whether the accumulated value of the premiums will be less, so in the event that they are less than the guaranteed minimum death benefit, then what is payable is the guaranteed minimum death benefits. However, in the event that the accumulated value of the premiums are actually greater than the guaranteed minimum death benefit, then what is payable to the policyholders' beneficiaries is the accumulated value of the premiums. So that is the first form. So in some cases, again, there's also a guaranteed minimum maturity benefit payable, which is what you've said. And then in the UK and most of Europe, these are called unit-linked policies and rarely carry. So in this case, they revert back to the unitized with profit types of contracts. So in Canada, they're also known as the segregated funds and carry a maturity guarantee. So the second form is what we call the second form, still a form of the equity linked insurance types of contracts. And under this, the policyholder is guaranteed again a minimum return on their premium. Again, of course, you must subtract any expenses so that at maturity, the policyholder receives a portion of the return on a specified stock index. So in this case, this premium chosen for investment is actually invested in a stock within the stock market, or it can be a stock index itself. So that if that is greater, if that is greater than the guaranteed minimum return, then the equity-linked insurance or assurance are generally rather offered at a shorter period of time than the unit-linked. And because simply why that is the case is because the volatility observed within the stock market is really, really high. So you do not want to guarantee a minimum for a very long period of time because you do not know the behavior of the stock market. So in this case, we are saying that the proceeds of the investment vehicle chosen is actually a stock index or a portfolio of stocks. Let me have questions before I move on to the life annuities. David Munene, who else is with us? Any questions? Please ask questions. You at least made it for the class, and it is therefore important for you to leave knowing most of what we've covered, or to have a distinction. Can we move on to the life annuities? I need you to signal me. Yes, Nyaga?
Yes.
We can move on. Okay,
we can move on.
Okay,
Yeah.
so we now want to look at life annuities. So with the assurances, we have determined that benefits are payable upon death. Yeah, except for the endowment, which is payable again at maturity. Now with the life annuities, there are now a different type of different types of contracts. And these contracts, an annuity in itself simply means a regular series of payments. So when we speak of a life annuity, it means that this we call them now annuitants and not necessarily policyholders. So the annuitant is the one entitled to receive this regular series of payments. So that an annuity is payable to a life that is alive. So a life annuity is a payment of regular series of payments to an annuitant as long as they continue to be alive. So it is possible to have a term life annuity, in which case, if we speak of a 5-year life term, a 5-year term life annuity, it means that the annuitant will receive regular payments for the 5 years. So it is not one single sum assured benefit tied upon their death. No, in this case, it is some regular periodic payments, which can be annual, quarterly, 5-yearly, and so on, within the term of the contract. So that if it's a whole life annuity, then this annuitant will continue to receive this regular series of payments throughout their life until the annuity, until the annuitant dies. So we are saying that annuities are often purchased by older lives to provide for themselves the retirement income. So if I take you back to our case application here, so we had the second case application, which was on the annuity, where Justin was looking to invest in the M-Pension individual retirement account. And they were doing this so that they're able to plan for a comfortable retirement. Yeah. So what happens is that they will continue saving into their pension fund, and once they hit their retirement in 60 or 70, whichever the case be, they will receive a lump sum benefit from their retirement fund or their retirement pension scheme. So what do they do what do they do, or what will Justin, upon retiring, do with this money? One of the options is actually to purchase what we call the life annuity, which is what we are now considering. So that in them purchasing this life annuity, they can do it they can do a single premium with the proceeds of the retirement from the retirement benefit scheme, so that out of the life annuity product they will have purchased, they can now be receiving regular income. Because you appreciate that by the time someone is retiring, it means they will no longer be able to work because they are too old and do not have probably the energy, or are not eligible for new employment. So they can actually purchase a whole life annuity so that it provides them with regular premiums of income during their retirement age until they die. So buying a whole life annuity guarantees that this pensioner, let's assume Justin in this case, will not run out of money again before the annuitant dies. So we shall see the distinction here of the different types of contracts. And the first one is what we call the single premium deferred annuity. So the description or how this annuity works is in the name itself. So there's a first part, which is the single premium, and that simply means the policyholder who is paying for the premium, who is paying for the annuity contracts, pays a single premium. So that in this case, if Justin received that lump sum, let's assume once they retire, they will receive, let's say, 10 million in lump sum, they can now pay that entire amount or purchase and life annuity with that amount and pay a one-off. So by single premium, we are meaning that the policyholder is actually paying a single premium in return of an annuity. Now, the second part of that name is the deferred annuity. So after they have paid a single premium for the contract, the annuity payments will be deferred, meaning that they will not start immediately, but rather they will start at some future dates. So it can be a single premium 5-year deferred annuity. So that in that case, it means that the annuitant will only receive the payments after the 5 years, or the regular series of payments will only commence after the 5 years. So we are saying that under the single premium deferred annuity, the policyholder pays a single premium in return for an annuity which commences payments at some future dates. And this date need, of course, to be specified. So we are saying the annuity again is life contingent, and that simply means that the annuity is paid only if the policyholder survives to the payment dates. So that if the policyholder dies before the annuity commences, there may be a death benefit due. Yeah. However, the annuity, the regular series of payments, will not continue if the life is dead. So if the policyholder dies soon after the annuity commences, there may be also what we call the minimum guarantee period, in which the policyholder's estate or the policyholder's beneficiaries can actually be compensated. Is that definition clear of how the single premium deferred annuity works?
Yes.
Thank you. So we have the next one. The next one is simply now another modification of what we've looked at. That's now the single premium immediate annuity. So for the single premium part, works the same as the single premium deferred annuity case. So we are only expecting that this policyholder will only pay one lump sum premium. But now for the immediate annuity, it simply means that the annuity payments, the regular series of payments, will commence as soon as the contract is actually effected. So it means that if they have bought, if Justin had bought a single premium immediate annuity with his lump sum retirement package of 10 million, they will pay the million today in advance. And at the end of the term, the first year, they will start receiving annuity payments. So in that case, there's no deferment. So the contract begins as soon as the premiums are actually paid. So another modification is the regular premium. So again, regular premium deferred annuity. So for the regular premium, it means that now instead of just in paying with the entire lump sum, they can actually be paying on a regular basis. So this means that they will be paying during this deferment period. The deferred, again, still means that the payments are not commencing immediately. So if it's a 5-year, if it's a regular premium 5-year deferred annuity, during this deferment period, then Justin will be making regular series of premiums. Let's say annually, they will be paying, let's say, 100,000 annually in terms of premium during the 5 years, that is the deferment period. And once the deferment period ends, then the annuity payments can now start being made back to her. So that's the distinction. So we may not now have a regular premium immediate annuity, simply because you realize once the annuity payments commence, they will continue until the death of the policyholder. So you need for this policyholder to have paid enough for that particular contract. So that's why we can have a single premium immediate annuity and not a regular premium immediate annuity, because the policyholder will not have made enough payments for the contract. However, we can have the regular premium deferred annuity, because within this period of deferment, the policyholder will have finished paying up for the contracts. So this, all in all these cases we have looked at, this we have assumed that it is only one life being considered. So it is possible now to have joint life or the annuity contracts being issued to couples, being issued to, it's typically couples, because you find that by the time people are retiring, they more or less will be the husband and the wife, because the children will be long gone and will not be under their care anyway. And so it's possible to have now contracts, annuity contracts tailored for the two lives together, so that we do not, they do not individually purchase annuity products, but rather they purchase an annuity product. So we have variations offered for two lives. So the first one is the joint life annuity. And under this, a joint life annuity is issued to two lives. And we are saying that's typically a married couple. So in this case, the annuity may either be a single premium or a regular premium. Again, it can be a deferred or an immediate. So it can be a joint life, regular premium deferred annuity. It can be a joint life, single premium immediate annuity. It can be a joint life, single premium deferred annuity. So the key distinction here is that when we speak of joint life, we're looking at two lives. So the annuity, in this case of the joint life, continues while both lives survive and stops or ceases on the first death of the couple. So if we, so if you have, let's say, Mrs. A and Mr. and Mrs. A, who have purchased a joint life annuity, it means that they will continue to receive this regular series of payments, these annuity payments. And in case Mrs. A dies, then the company will stop paying the annuity payments. So we are saying these annuities will continue as long as both live continue to survive and will stop once death occurs in either of the lives. That's why it's being called a joint life annuity. The annuity payments are only continuing if the two lives are actually alive. When we speak of the last survivor annuity, now this is now similar to the joint life annuity with regards to being offered to two lives, except that payment continues while at least one of the life survives, and only stops upon the second death of the couple. So this is you can perceive it to be a better type of contract, because in the event that Mrs. A dies before Mr. A, the contract will still continue to pay, or the annuity payments will continue to be paid to the life that is actually surviving. So we also have what we call the reversionary annuity. And remember, like we said it for the joint life, even for the last survivor, it can either be a single premium or a regular premium, or it can be immediate or deferred. Yeah. So in the same sense, for a reversionary, it can also be single premium or regular premium, or immediate or deferred. So when we speak of a reversionary annuity, it's still again contingent on two lives. Again, we are saying it's typically a couple, and one is designed, so one is designated. So we have said it's two lives. So one of these lives is actually designated as the annuitant, and the other one is designated as the insured. So those are the roles. So no annuity benefit is actually paid while the insured life survives. So on death of the insured life, if the annuitant is alive, then the annuitant receives an annuity for the remainder of his or her life. So we are saying that in this case, one person who is the annuitant is the one who is entitled to receive this annuity benefit. The insured is the one who is paying for this particular contract. However, the annuitant will not be entitled to receive any monies as long as the insured party is actually alive. So it is upon the death of the insured that the annuitant will now start receiving the annuity payments. Does that make sense? David, Monene?
Yes.
Does make sense, yeah? And this is the situation where you find that in developed countries, you find we have people who kill each other, yeah? So that they can get compensation from the insurance company. And this is a scenario where that can actually happen. So that is how it actually works. That's the reversionary. The last one, it was actually the last one. So under these types of contracts, the annuity contracts, we have said we have single premium deferred. We have seen the distinction. We have the single premium immediate annuity and the regular premium deferred annuity. We have also seen why we cannot speak of a regular premium immediate annuity. We also have the joint life, the last survivor, and the reversionary, which we have said are typically issued to two lives. So those are the types of life insurance and life annuity products. And the major risk there that is covered is actually the risk of mortality for the sake of the life insurance contract. And in the annuity case is the risk of longevity, meaning longevity means the risk of actually living longer than anticipated. And we now have other types of contract, which often you find in some cases they can be classified under general insurance, in some cases they can be classified under life, but they do not necessarily cover the risk of mortality. It is not the risk of death in this particular case. So here we focus mostly on the risk of morbidity. So the risk that someone is affected, someone probably got into an accident and can no longer be able to work. So those are the types of contract we are looking at, which covers the morbidity risks. So the first one is the income protection insurance. And when we speak of the income protection, this is when a person becomes sick and can no longer be able to work. Their income will, of course, eventually be affected. And for someone in regular employment, the employer may cover salary for a period. But if that condition or the sickness continues, the salary may be decreased and ultimately stopped. So if this particular individual had bought an income protection insurance policy in the event of this sickness, which has affected their income source, then it is possible for them to actually, the insurance company to replace at least some of the income during those periods of sickness. And usually that can cease at retirement age. So you can see it is out of the sickness that this person is no longer able to work, and then the insurance of this particular cover, policy cover, comes in. So we also have another type, which is the critical illness. So again, due again to the critical illness, so this is so this one is now, the distinction between this and the earlier one is that in this case, we are now focusing on illness. In the other one, we were looking at the ability of someone, the inability of someone to continue working, which can be attributed to sickness, or which can be attributed again to an accident and so on. Now with the critical illness, we are now focusing on the financial burden, which is now associated when someone is diagnosed with a critical illness. Because you appreciate that the cost of, for instance, treating cancer is really, really expensive and can affect the financial status of an individual or even an entire family. So for some serious illness that can cause significant expenses at the onset of the illness, the patient will have to leave again employment and alter their home, or may incur severe medical expenses. So this policy, that's the critical illness insurance, pays a benefit on diagnosis of one of a number of severe conditions. So that the benefit usually offers a lump sum. So it means that if when you are healthy, you had bought a critical illness insurance policy, and then you are diagnosed with cancer, let's say 5 years after buying the contract, then the insurance company can actually now pay a lump sum to help you meet the cost of the medical bills associated with that critical illness. Another last one is the long-term care insurance, and this is often purchased to take care of people in their old age, where when the insured life is no longer again able to continue living independently. So they may need probably a nurse to be with them constantly. And the benefit will be in the form of long-term care, so that in this case, it can take the form of annuity benefit, so that it is paid on a regular basis. So with all this, they have covered the morbidity risk, so that when someone is affected due to either critical illness or another illness or accident, or due to their old age and can no longer be able to fend for themselves, then the respective type of contract comes through. So, David, do you have any questions?
No.
Okay, so in our next class, we shall look at general insurance. So make sure you go through the materials beforehand, because at least for that, that's a bit clearer. And since you have looked at risks and we've covered some of them, then it should be easier to even read through those materials. So we'll stop at that. Enjoy the rest of your weekend.
Thank you.